Coming up today, is the stock market doomed? A look at the jobs report, bond yields in oil pullback, Bitcoin's brief flash crash, and the latest survey of billionaires and where they plan to invest next year. Let's go, guys. And welcome back to the Daily Market Review, everybody. And the option dealers were right. Just as they had forecast yesterday, we were set for a sleepy finish to the week, and that's exactly what we got. Another low-range day here on the S&P 500. Jobs report pretty much came in line as expected, and I'll get more into that a bit later on, but just looking at market color, we've got a few sectors pulling back in the short term. Across the board, except consumer discretionary and tech stocks. Also seen a bit of a bounce back in international stocks. While we've got quite a bit of weakness in the oil and energy sectors, which I'll get into a bit more later on as well. However, the S&P 500 oscillator looks to be in grind mode here, at least for the main indices. But looking underneath the hood tells a bit of a different picture, looking at sector breadth. Like I said, except for discretionary and tech, everything else is pretty much pulling back in the short term here. And since we just finished the week of trading, first week of December, look at that weekly sector performance. We've got a K-shaped market going on here. Bunch of sectors going up and a bunch more going down. Energy, utilities, and materials the weakest. And like I said, the big tech stocks, the Amazon, the Teslas, and a few others performing really well month to date. Just looking on my regular technical chart, fourth reversal signal firing off on the SPY. Remember, it can only do 5 in a row. And the last few times we've got these reversal signals has indicated either a little bit of a short-term top or a bit of a pause consolidation in the market. So we very well could be vulnerable to a bit of a pause and consolidation next week. And just looking at my seasonality forecast here, at the 21-day forecast, on average 21 trading days in a month. Looking back over the last 5 years, for the next month forward, typically the S&P goes up 1.4%. However, if I just switch over to the equal weight S&P, it's more than double, 3%. And again for the Qs, pretty soft at 0.62%, but going to the Qs equal weight, 1.9%, and doing better once again, mid caps, 3.65%, with the best seasonality forecast for the Russell 2000 small caps. On average over the next month, small caps have performed the best. We can see that going through December into January and February as well. And so small caps actually finished down on the week. They had a bit of a pullback this week, while it was really mega cap tech taking the charge here this week, after it consolidated for a few weeks there after the election. And just looking at the VIX today, as I'd forecast after the election, we're on our way down to a 12 handle. We did get a bit of a bump up there a few weeks ago, but we just made our way down to a 12 handle for the first time in quite a while actually. Have to go all the way back to early July. And the market's just in absolute grind mode. Look at realized volatility, absolutely dropped this week. Market's moving on an annualized pace of 7.66%. And I'd say that really suppressed reading is what's given us that bit of a bump in volatility risk premium. So in other words, there's still room for the VIX to fall. Could very well go to 11 or 10 handle come Christmas, New Year. Nonetheless, still a good time to add some hedges if you're into that sort of thing. And stick with me today because I'll show you a bit later on the latest survey of billionaire investors and what they plan to increase and decrease their allocations to next year. And I'll also share with you probably the most craziest stock chart you've ever seen as well. But like I said, we've got a lot of dispersion in this market. Some sectors going up, some sectors going down, small caps pulling back this week. We've still got a bunch of really hot small names out there, showing there is a bit of froth in this market. Animal Spirits are once again running hot. Destiny Tech 100 Fund, over a third of it invested in SpaceX. The last time I checked, the net asset value, the NAV of this fund, marked market, was around $10. I think SpaceX just had another tender offer, valued them above $300 billion. So maybe the NAV now is more closer to 14, 15, but still, this thing's gone wild now, up 30%, trading at $71 a unit after hours as I speak. So this is the real pointy end of speculation in the market, but also looking at the beneficiaries of a hot market. Robinhood having another good day today. Wall Street Bets Forum is lighting up again, and so is Reddit stock, up 6.32%. Along with the biggest fund managers, BlackRock, still on a parabolic uptrend. Same deal with Blackstone. Pretty solid uptrend for the asset managers, and same with other brokers like Interactive Brokers, having a pretty good year. And the biggest bank in the world, JP Morgan, trading firmly as well. But once again, it's quantum computing, just lighting up the screens today. D-Wave Quantum up 34%. Rigetti Computing, 37%. And these eVTOL stocks bouncing back the last few days after they got slammed on Monday. We had these big bearish reversal candles to start the week off, but they're now trying to reclaim some of that lost territory. NuScale Power in the nuclear sector bouncing off its 50 here. And then the AI robotics trade is also lighting up today. Serve Robotics, 23%. Big Bear AI on a monster run with volume, along with C3 AI, these smaller AI stocks. My favorite small one, SoundHound AI, another 12% today. This thing's gone vertical. Of course, it won't last forever. I think we're due a pretty sizable pullback in some of these names, but the market could be shifting its focus. Like I said, been getting a lot of these small biotech stocks performing well this week. And one I highlighted at the start of the week, Ginkgo Bioworks, ticker symbol DNA, up over 20% today. But the biggest AI stock of them all, not joining in on the party. NVDA actually pulling back today. However, probably the hottest AI stock this year, Palantir, continuing its monster run again today. I actually closed my position in this as part of my stock picks portfolio on Monday morning at $67 a share. And so of course it would have been nice to hold on on for another week. However, when it comes to investing, you rarely buy the bottom or sell the top to the exact point. But like I told my subscribers, why I did sell it is because it's pretty much gone vertical now. Just going out to a monthly chart here for you. I think it's on an unsustainable velocity. Its beta's got super high, almost 3. So basically every percent the market moves, Palantir is expected to move almost 3%. And now its price to sales ratio is over 70. So every $1 million in sales it's done over the last year, the market's currently valuing it at $70 million. The only stock in the entire market with a higher price to sales is MicroStrategy. And so no doubt it could keep running further. Wouldn't surprise me to see $100 a share. However, it will have a sizable correction and pullback at some point, and there's so much hot money in here, it could very well crash. And so even though I haven't sold the exact top, I'm still happy with my 178% gain in it this year, and I'm happy to reinvest those proceeds equally amongst all other positions in my portfolio, which I think present much better risk-reward opportunities going forward. But this has definitely been one of the standout stocks of 2024. Now with a market cap approaching 200 billion. And for anybody else who's interested in jumping on my stock pick service, now's your last chance to save 33%. Coupon code SWING33 is expiring this weekend. And so if you're interested in jumping on my stock pick service, click the link below this video. Head on over to clickcapital.io, go over to stock picks, and you can learn more about it, including how my real money investing account is performing, along with all the details of this service, of which members have been really happy with, as I'm currently well ahead of target this year. And so if you want to find out what my next stock pick is that I'll be sending out this Sunday morning, then head on over to clickcapital.io, and you're welcome to follow me on this challenging journey going forward. But like Palantir, we've got other big stocks doing well this week too. It wasn't all just those hot small stocks. Tesla, been on absolute fire since earnings, up another 5.3% today. Could potentially take a stab at all-time highs next week, above 415. Others doing well today on the back of earnings, DocuSign, up 27% today after they beat expectations. And specialty retailers as well, Lululemon, up over 15% on their earnings. And as I said earlier, I was going to show you one of the craziest stock charts you've ever seen. Oriental Rise Holdings just came onto the market. They engage in the cultivation, processing, and sale of tea leaves and tea products coming out of China. And check out this price action. Yesterday, it was up 599% on 6.5 million shares traded. Today, it was down 93.5% on 27 million shares traded. And of course, it's usually only in China you can see completely crazy moves like this. But this is a good and quick analogy of what can happen in markets. They can get so carried away in the short term, only to completely flip their narrative and pricing around the corner. That's why you got to be really careful buying hot air on any asset, not just little small Chinese stocks. But it's moving on to some data and news. Look at these equity fund flows ever since the election. US exceptionalism, approaching 150 billion that's been plowed into US equity funds since the election, while there's been net outflows for all other global major markets. And we are having a pretty good year. Just looking at the year-to-date performance of the S&P so far, currently tracking about 26%, while our intra-year drawdown has only been 8%. And going back in history, it's not all that unusual. We have seen these returns and single-digit drawdowns as well. And there is a bit of a pattern in this data. You can see at least in the intra-year declines, there's a bit of waving. Up, down, up, down, up, down, up, down. And so typically after we have these drawdowns, they can bounce back up again. And so we had a decent one in 2022. Then we've bounced back over the last 2 years. Looking back in history, if that pattern were to hold true, it could very well give us a couple of more good years of low drawdowns before going back again. And in fact, one could draw similarities to the mid-90s. We had a period of great returns, low drawdowns, but then of course, we got the bear market and crash in tech stocks in the early 2000s. And so we're now just getting into the third year of this bull market after the October 2022 bottom the S&P made. And in fact, just looking at prior bull markets that made it past their second birthday, they typically tend to keep on going. 87, 5 years, 86 years, 07, 5 years, 11 years up to February 20. We had a pretty good run there in the late 80s into 2000 as well. So if this bull market were to finish soon, it would be the shortest lived bull market that made it to at least 2 years old. However, no doubt it's not cheap, depending on what index you use, the S&P 500, record CAPE ratios and the like, even though mega cap tech are absolute cash machine. Like this article in the Wall Street Journal says today, history shows no link between nosebleed valuations like today's and next year's returns. Expensive stocks can always get pricier. And I'd say generally speaking, it's more harder to time a market top than a market bottom. Typically, market bottoms happen a lot quicker than market tops. Market tops are kind of more broad in their nature. And since assets can just go on and on, higher and higher, grinding on low volatility, it's really hard to say how crazy things can get because there's absolutely no roof on the price of stocks. However, stocks can't go below zero, and typically when they go below book value, there's big money in there to scoop them up, and bottoms can happen quite quickly. We get those V-shaped bottoms. And that's why back in the mid-90s, many of the smartest people in finance, even Alan Greenspan himself, himself, much respected head of the Fed back then, was calling the market irrationally exuberant in 1996. Nasdaq tripled again after that. And so we do have the ingredients there for quite a bit of a melt up. Loose monetary policy, government that's set to cut regulations and taxes, American exceptionalism, huge amount of participation and accessibility into the market, amongst other things, which means we could very well set some new records yet again when it comes to valuation measures. S&P 500 currently trading on a 22.3 forward price to earnings ratio. It's actually still below where it got to in the late 90s. But look at that gap with the rest of the world. The rest of the world is just not priced for growth, just 14 times next year's earning. And like I said at the start of this video, I was going to share this UBS Billionaire survey of what the biggest investors' intentions are over the next 12 months. So in the dark grey is the percentage of respondents saying they intend to significantly decrease their exposure, then it's slightly decrease, keep exposure about the same, slightly increase, and significantly increase. And so what stands out here is billionaires are intending to increase their exposure to developed market equities next year. 34% expected to slightly increase, 8% significantly increase. Same with real estate. Billionaires plan to increase their allocation to REITs next year. Along with gold and precious metals, 40% of investors are intending to increase their exposure over the next year. And where they're looking to pull back from, private equity the most, hedge funds, cash, and a little bit in developing markets. Many billionaires still not sure on the China trade. But just looking at US economic data, consumer sentiment continues to rise. However, what was different this time? Short-term inflation readings hit the highest level in 6 months. And since it's the first Friday of the month, we got the jobs report coming in a bit better than expected. US economy generating 227,000 new jobs last month, a bit ahead of expectations from economists who were between 200 and 214. Unemployment rate came in as expected as well, 4.2%. With some saying this data actually supports the Fed holding monetary policy here. The Fed should pause their interest rate cuts when they meet in a couple of weeks. However, we've still got some Fed members saying, I believe that monetary policy is still restrictive, which is a pretty dovish sign. Considering the Fed themselves, they've got GDP tracking at 3.3%, inflation still hovering around the high 2s, low 3s, stock market at all-time high, animal spirits well and truly alive, looking at speculative areas in the market, and the Fed still thinks we're restrictive. They want rates lower. And interest rate traders believe them, now actually increasing their odds the Fed will cut when they meet in a couple of weeks. 85% chance. We've also got bond yields pulling back this week as well. There's a 10-year down to 4.15 now. Same with the 2-year pulling back. And this is kind of good action for the stock market. Yields are not falling off a cliff, indicating potential economic weakness, nor are they ripping, indicating inflation and higher rates. We can kind of just hover around these fours. It's kind of a sweet spot for the market in my opinion. Also helping out stocks and the consumer. Price of oil pulling back after OPEC Plus failed to deliver a strong message to the market that they're going to curb production after their decision to further postpone a planned reversal of production cuts. With one oil analyst saying current demand is insufficient to meet free market supply. The market simply can't absorb OPEC's 6.5 million barrels per day of spare capacity without cratering price, which would be detrimental to many OPEC members, budget deficits, most of all the Saudis. And there's a look at crude, once again testing this key support zone here, around $67 a barrel. And so maybe oil's about to get interesting over the next week or two. Because if it did lose support, that's going against a little bit of bullish seasonality here as well. And there's a look at gold, pretty much consolidated all week here, and silver, not doing too much interesting either. What did break out this week? Agricultural commodities, brand new high for the year. Price of food is going up. What else has been really hot this week? Bitcoin had a bit of a brief flash crash after trading above 100,000 for the first time. And what looked like to my eyes, potentially a whale offloading once it hit that big psychological level. With it falling 7% in just a couple of hours. Just goes to show you how hot and volatile it is. And in fact, according to Unusual Whales, in the past 24 hours, over 211,000 traders were liquidated in crypto, with the total liquidations coming in at 1 billion, which like I said, just goes to show you how inherently leveraged this asset is. That was the candle yesterday, just a spinning doji, didn't even get near its 50-day VWAP. That still caused over 210,000 crypto traders to be liquidated. And just imagine how many millions of crypto traders will be liquidated when it has its next big 70 to 90% bear market, like it has a history of doing. However, this could be the supernova epic melt-up of this entire secular bull market cycle that we're in now. With Bitcoin's biggest cheerleader, Michael Saylor, saying today, I'll be buying the top forever. I'm confident I'll be buying Bitcoin at $1 million per coin, which will likely be around $1 billion worth of Bitcoin per day at that price. So in other words, if Bitcoin gets to $1 million, he's going to keep doing his nifty little trick of selling convertible bonds and play on it into Bitcoin. And he's dreaming of doing $1 billion worth of that every single day. Like I said, he's going to do this as much as he can. And if he gets his way, well, then you're looking at the world's first trillionaire. And there's a look at MicroStrategy. Still one of the most traded stocks in the market, still seeming to recover from that massive bearish engulfing we got a few weeks back. And which I said back on that day, looks like someone put on a monster pairs trade because Bitcoin went up on that day, MicroStrategy went down. And there's a spread of Bitcoin versus MicroStrategy. Had gotten pretty cheap there. So they had a pretty good starting point on that open. And that was a big volume day. And the spread hasn't even been able to retrace halfway of that day. Looks to be holding on here. Actually getting a pretty big bullish divergence on this spread here. And there's the monthly chart of this spread going back a decade, Bitcoin versus MicroStrategy. And I can see why big hedge funds may be interested in this at the bottom end of this range. Certainly a lot of potential in this spread if that premium does get evaporated. And in fact, these funds may be able to force that premium away. However, in my opinion, they're just going to wait for the next sizable correction in Bitcoin, if not bear market, as I would expect MicroStrategy to fall at least 80-90% when that inevitably happens. And all those small investors, sailors roped in, they'll be left holding the bag as he's offloaded 70 million shares in MicroStrategy this year. However, almost every day throughout my social media feeds, I see detailed technical arguments as to why this time is different. And MicroStrategies like the new treasury for Bitcoin and all these other clever sounding names they come up with. But again, we don't know how crazy it will get before I'm almost convinced this will crash 90% again, just like he did after the last tech bubble. Also in the spotlight this week, United Health, after the unfortunate killing of the United Healthcare CEO who heads up their insurance arm. Stock getting whacked again today, down another 5% on heavy volume. Pretty big move for the normally sleepy blue chip. Might be some big investors not wanting to be a part of this anymore. Since it's now going viral online, they knocked back almost a third of all their claims. And just looking across social media, I've actually seen way more people show more anger towards the health industry than sympathy towards Brian Thompson, the victim of this killing. And in fact, the assassin's bullets had deny, defend, and depose written on them, to a reference to the book with the same expression about how the health industry denies coverage on a systematic level. And in fact, one poll I saw on X asked whether Brian Thompson deserved what he got, for which I answered no. However, I was a little surprised to see more than half of all respondents, and there was over 100,000 on the survey, said yes, which just goes to show how angry a lot of Americans are with the state of their healthcare industry. And many people are starting to share photos of recent bills they've received, which again, for those of us outside of America, are kind of mind-blowing to see, as we don't really see this stuff. It cost my mum $275,000 to die, being admitted to hospital. CT scan, $5,173. Blood storage and processing, $5,300. And the smallest one on here, but I think the most dodgy, education training, $100. They just had to slap that on in the end. On top of this ridiculous bill, over $250,000, they also charged this person $100 for education and training. Just goes to show what an absolute joke it is. But anyway, hopefully RFK can clean it up somewhat. Of course, that's easier said than done. It's been wrong for so long. But healthcare stocks are selling off. They are pricing in something's come for them, as I think the costs of US healthcare might have just hit a blow off top, and this killing may have just marked that. And just getting back into the charts, we've still got some of these big names having a strong performance today. Amazon up almost 3%, all-time highs. Meta as well. Well, Apple continues its pause here. But you know, things are getting a little frothy when you see funds like ARK Innovation, which systematically invests in overvalued shares. Just looking over the last 5 weeks, it's already up 36%. So definitely some areas of the market are getting a little hot, just like Palantir and some of these other small names. Could very well carry through Christmas. However, the hotter they get, the bigger the correction and pullback we're inevitably going to have. So just be prepared for that if you're in some of these hot names. Most likely come January, February at the latest, in my opinion, especially if we've still been cooking since then. We're likely setting up a pretty sharp reversal and correction, and that'll most likely happen across the board in crypto as well. But for the here and now, things are looking good. We just got inflation expectations break down to a new monthly low. They're actually now lower than the day before the election. Got high yield spreads holding up really well, along with growth sectors versus defensive sectors having a really good week. Same with discretionary versus staples. Market's absolutely in a risk on growth mode, and we can see that with value stocks coming off versus growth stocks this week as well. Not to mention the VIX at 12.7, and like I said, the way things are looking could very well go into 11 or even a 10 handle come New Year, because the market is kind of in this drift mode now, even though we've got a lot of rotation going on underneath the hood. Mega cap tech has taken the front seat once again, along with other hot areas of the market. And that's pretty much a wrap this week for the daily market review, guys. Thanks very much for tuning in. And like I said, anybody who is interested in getting my stock picks, indicators, or online course, now's your last chance to save 33%, as the coupon code SWING33 will expire this weekend. Otherwise, enjoy your Sunday, and I'll be back again come Monday night. Cheers.